All right, guys, let's talk about HELOCs. This question about HELOCs, how they work, is it good for me? Should I consider one? This is coming up all the time right now. In fact, we have a lot of HELOCs in the pipeline, so I thought it would be good just to film a quick video and explain to you some pros, some cons, some things to consider when you're looking for a HELOC. Now, first off, there are more than one way to pull cash out of your house. In a second mortgage, you can do it as a HELOC or you can do it as a HE loan. Now, the difference is really this. A HE loan works very much like a first mortgage. It's going to have a defined term. So let's say it's a 10-year loan, a 20-year loan, a 30-year loan, and it's going to have an interest rate and it's going to have a loan balance. And that loan is completely funded at closing. So as an example, let's say somebody applies for a $200,000 HE loan on a 20-year term at 7.5% interest. They're going to have a specific monthly payment that they're going to make all the time. Now, if you throw extra money at that loan, you're just simply paying the debt off, but that monthly payment's not going to change at all for you. Now, a HELOC has some really cool advantages in that most people will opt for a variable rate HELOC. Now, I'll talk about a fixed rate HELOC in just a second, but the variable rate HELOC will follow the market. Now, this is really good right now because the interest rates are slightly on the decline. In fact, the forecast is that we'll see some additional rate reductions from the Fed maybe in December, and then through 2025, there's somewhere around maybe 1 to 1.5%, depending on who you talk to, that's forecasted for reduction. So today, prime rate is 7.75%. Now, prime rate is what the basis for a lot of these HELOCs is, so you can expect to have at least a 7.75% interest rate, plus, depending on your terms, how much you're borrowing against the house, what your credit score is, things like that, you're gonna have a margin that the bank's gonna apply to give you your total loan. So let's just say that you had a loan that was approved for prime rate plus a quarter. On a variable HELOC, you would have an 8% mortgage rate. Now, that 8% is only applied to the money that you actually use. So let's say that, again, you had a $200,000 line of credit through the HELOC, but you only needed to use $100,000 to get some home improvement projects done, pay off some debt, consolidate some credit cards, things like that. Then your interest is only being charged to you on the 100 grand that you use, not the entire $200,000. The rest of that money is there for the future. If you ever need to use it, it's there for you. If you have a great investment option, you wanted to use some of that money to help fund, if you wanted to use it for maybe some additional future improvements on your house that you just aren't ready to do just yet, you're not paying interest on that money while it just sits in the bank. It's sitting on the line of credit and it's there waiting for you to use in the future. Now, variable HELOCs work really good in declining rate environment like we have right now. The Fed's lowered rates down in September by 0.5%. We just had another one here in November at 1/4. December's projected to be potentially 1/4, maybe hold, just depends on what's going on there. And then in 2025, somewhere between 1 and 1.5% in reduction. So the neat thing on a variable is that that interest rate will follow the market. It's going to come down. Now, there's also some scary stuff. It can go up. So if the Feds decided they were going to increase rates, they were going to slow the economy down by increasing rates, it's going to directly impact a loan like this, and it's going to crank those up. Now, we would have seen this over the last couple of years because that was kind of the game plan from the Fed. What we've heard from the Fed multiple times, they're going to lower rates down over time. They want to actually try to stabilize things, have a soft landing, if you will. And so these variable HELOCs are actually kind of a nice way to go. Now, if it scares you entirely to have the variability, the option for that rate to potentially go up to a significant amount, there is a fixed rate HELOC that's available for you. And the fixed rate HELOCs right now, for most of the loans that we're pricing, they actually price better than the variable. It's almost like the banks are saying, hey, use this, like let's guaranteed and lock in this rate, this interest that we're going to receive as a bank, because they have a really good understanding of the market, and they also think rates are going to come down over time. And so at some point, even though today maybe the fixed rate is a little bit better than the variable, in the next year the variable likely is cheaper than the fixed rate, and the bank will end up winning because they'll collect more interest. So there's a little bit of an incentive right now to choose the fixed versus the variable. A couple other things on the HELOC. There's a draw period. So the way that these loans work, they are typically 30-year loan terms. That's the repayment. That's how long you have to repay that debt. But within a window of time, they call it draw period, you're going to have the ability to throw chunks at that loan if you wanted to pay it down and open up the line of credit, and then to borrow money back off of it. And you can do that as often as you'd like in that draw window. Now, a lot of these loans are either a 3-year, a 5-year, or a 10-year draw window where they allow you to do that off and on as you choose for those periods of time. Now, the loans that price the best usually have a shorter draw window. So if you don't plan to use this all the time, you're just going to use it maybe for the next couple of years, a 3-year draw window is just fine. you'll probably get better terms on seeking something like that. But if it's something you want to just set up and be done with, and you intend to use it on an ongoing basis, maybe you need a 5 or a 10-year draw window. You just might have a little bit of a premium on what that loan looks like on the total terms of that loan. Now, the payments that are on these loans are done interest only for the first 10 years on almost all of them. There are some variability between different banks, but most of the time for the first 10 years, you're going to pay back just the interest on the loan as your minimum monthly payment. Now, you can pay as much as you want. You could throw whatever you want to for principal and get that loan paid down very quickly, just so you're not paying interest on that extra money that you maybe don't need. Maybe you have extra cash in the bank and you look at it and you say, hey, these are up in the 7s and 8% range. Maybe it's a good idea for me to dump some of this money there versus letting it sit in my savings account. I'm not making any interest on it. So a good place to park that money and then still have access to it in an emergency or in the future as you so need. These are typically used for all sorts of things. So you can use these for whatever you want on your side. This is a debt against your home, so you're not paying a capital gain tax to the IRS. There isn't a fee to the IRS like there would be if you were to pull from, say, a 401k to access some money. So this is a really good place from a tax perspective to make sure you don't get raked over the coals with the IRS for taking some of that hard-earned money that you have. This is your equity. You can tap into it because it's debt. It is not taxed. So that's a really good tip. The other thing is maybe you use it for debt consolidation. A lot of people right now have some really heavy credit card debt. I've heard from some as high as 26, 27, even 28% interest. I think the average is like right around 22.5% in the United States. And the average homeowner has somewhere around like $20,000 worth of credit card debt. This is a great place to consolidate that because you're significantly reducing down how much interest you're paying over time. You can also use it for things like, let's say your home improvement. You got a home improvement project you want to use, or you want to complete, maybe you want to complete the kitchen, you want to modernize the bathrooms. This would be a great place to pull some money, use your equity, have it go back to work for you. But one other place that I see an opportunity, and I don't see as many people doing it right now because I think they're just nervous about the market, is using that money, so using the equity position through a HELOC to help you fund and expand your real estate portfolio. Now, this is a little controversial. I can't tell you, hey, go pull money from your house to go invest it, and you're gonna make this big return. But I think if we run through the numbers, it's gonna show you that it's actually fairly safe. I'll give you an example. Let's say that you wanted to purchase a investment property and you know that it's gonna run you maybe like 60 grand to get that investment property, to pay for down payment, to pay for the light rehab, the closing cost, etc. And that property, after we do the math on it, we realize it's going to spin off about $400 or $500 in terms of cash flow each and every month back to you, right? The tenant's going to pay off the main loan on that. You're going to have a little profit left over for you to cash flow. You can take that extra cash flow and immediately start to knock down the money that you pulled from the HELOC to fund that initial purchase. Essentially, you're using your equity, which is considered a kind of a dead asset, right? It's a non-performing asset. No doubt on paper, it is an asset to you, but if it's not out in the marketplace bringing more money back, it's actually non-performing. It's not doing anything other than just making your numbers on paper look really good. So I've seen people actually that want to invest in real estate that have had a hard time maybe stacking up 20, 25, 30% down to get started by buying another house as an investment property, but they're sitting on a ton of equity. This is a great place to pull some of that equity. Be strategic on where you place it. Be strategic on what we call buy box for your investment property, and then move that money and get it to work for you. Now, you got more than one home. Yes, you're a little bit leveraged, but it's also easier for you to get started right now versus you just saving that money over time to stack up that cash that you need to make that purchase. And remember, with that cash flow, as long as we're buying smart, we're not buying a home that's going to have negative equity. We're not buying a home that's going to have a negative cash flow position from day one. We want a property that's going to hit your specific terms. Maybe it's $300 a month in cash flow. Maybe it's $800. I just talked to somebody yesterday who's $800 to $1,000 in cash flow. If it does not hit that number, they will not buy it. But they're also very aggressive, and this person had about 25 properties right now. So they're finding them. They're out there. They just may not be in your backyard. This is an individual that I was talking to out of state who's doing really well with it. You know what they told me is immediately after they get that home rented, renovated, whatever they got to do to it to make it stable, they are getting a cash out refi on it to pull their money, as much of their money back out of it, let it self-sustain, and then redeploy that money into another property. It's how they've been able to scale. It works really well. We call that the BRRRR strategy here in real estate, and that would be something worth exploring. So for those of you that have just a ton of equity right now, maybe you want to consolidate debt. This is a good place for you to kind of take a look at it with the HELOC. Maybe you want to do some home improvement, and maybe you just want to start the conversation around investing it, getting it to work for you. See what the numbers look like on that. Give me a shout so we can run through some numbers. These are really easy for us to forecast out. We don't need to do hard credit inquiries, just to run some simple numbers for you. Again, we use these loans all the time to help families. We do them in a variety of states. So reach out, let us know how we can help. Happy to run some numbers for you, and I'll talk to you soon.